Good morning. I'd like to thank the Schiller Institute for inviting me to make this presentation to you this morning on the fact that we face financial events, again, like those of 2000, 2007, 2008, perhaps worse, and where they are coming from. We are going to be, as you'll hear from Helga Zepp-LaRouche, we're already calling on the leaders of four nations, in particular, the United States, Russia, China, and India, to initiate actions towards a new international credit system, a new international monetary system that is credit issuance and currency value control. And this is basically why this is necessary. 18 months ago, I published a warning in Executive Intelligence Review, our weekly magazine for many years, that describing the fact that corporate debt in the United States and in the European countries, swelling very, very rapidly into a bubble, was forming the same threat of financial crash that had been formed in the first decade of this century by predominantly real estate debt and the securitization and derivatives based on that real estate debt. Corporate debt, which in the US and Europe among non-financial corporations had totaled about $7 trillion in 2010, had ballooned very rapidly by the end of 2016 to 14, it had doubled to $14 trillion. It's significantly higher than that now. And at that point, already 18 months ago, it was clear that the quality of this, the credit quality of this debt, both bonded debt and loans, particularly leveraged loans, was beginning to deteriorate in such a way that this bubble could very easily blow up. We now are in a situation where many such warnings come. In fact, one came from the International Monetary Fund, the so-called IMF blog, only 2 weeks ago. 2 weeks before that, in an interview with the Financial Times, the same warning was given by Janet Yellen, the immediate former chair of the Federal Reserve in the United States, who particularly focused in her interview on the rapid deterioration now going on in the quality of this very, very large and very rapidly growing corporate debt bubble in the transatlantic countries. For example, of the investment grade portion of that debt, fully half of the investment grade portion has dropped now to a rating of just one rating above junk. The junk bond, that is leverage loan and junk bond, junk debt portion of that 14 plus trillion at this point is in excess of $4 trillion. It is much larger, in other words, than the subprime portion of the mortgage debt in the U.S. real estate market was in 2006 and 2007. The markers of repayment of this debt, the existence or non-existence in this case of covenants for repayment in most of the new debt that is being issued, and in addition, the tremendous amount of borrowing in order to purchase stock of corporations, that is, corporations borrowing in order to buy back their own stock from the market. This has made it an even more dangerous situation because those corporations are simultaneously, in doing that, are simultaneously reducing their capital while increasing their debt. And in the last year, in this year, 2018, in the United States alone, the total of that corporate debt, corporate stock buyback is headed towards about $1.3 trillion. That's the rate at which it's going. aided by the tax cut, the corporate tax cut, which went into effect 1 year ago in the United States. This is a bubble, as I say, much larger than the one which collapsed in real estate in 2007, 2008. And like that one, it has been securitized. That is, the increasingly toxic parts of this debt, the increasingly unpayable parts of this debt have been turned into securities, have been issued by major banks which owned it to funds of every kind, money market mutual funds, pension funds, health insurance funds, all over the United States and Europe. And this way of getting rid of what the banks are aware is debt of very rapidly deteriorating quality is actually the most dangerous aspect of this, because it directly impacts our ability to survive it. Now, one, as I said, can hear now many official warnings of a corporate debt bubble, which is at some stage going to blow out. The fortunes and forecasts of this are rather strange in that when they are applied to the United States and Europe, the forecasts are made in terms of a supposed cycle of 8 to 10 years, that you reach 8 to 10 years since the last crash and you're going to get another one. And there's a lot of jostling and betting as to when that point is going to come. Whereas on the other hand, when they turn their attention to China, which has not had a recession of any kind for more than 35 years, and is an object, its economy is an object of some astonishment recently in Bloomberg articles, New York Times articles, and so forth. One was called "The Land That Failed to Fail." This economy, which has been without recession for more than 3 decades, well over 3 decades, is, on the other hand, forecast to be about to go into a complete collapse at any moment. So obviously there is something a little bit extreme in these forecasts. What makes much more sense is to look at the fact that a period of successive financial crises of this kind, including bank panics of the kind which happened 10 years ago, began at the point of massive bank deregulation in the United States and Europe. And that, as most people know, began in the middle 1980s with what was called the Big Bang of bank deregulation in London, and then rapidly was imitated in the United States and to one degree or another in other European countries. And from that point in the middle 1980s, when bank deregulation and particularly bank separation between investment banking and commercial banking, deposit banking, when that was thrown out the window, it opened up a period in which, in fact, financial crises have been occurring much more frequently than once every 8 to 10 years. And in fact, the period since the great financial crash of 2008 has been rather a long one. In that period since 1986, when beginning with the immediately following stock market crash of August of 1987, there have been a series of rolling crises, each one tending to be created by the money printing and extreme low interest soft money policies of the major central banks following the previous one. And that is the situation which has obtained since then and has brought us now to the point of yet another, and perhaps worse than a decade ago, financial blowout that we're facing now. I can't tell you with precision when that is going to happen, nor whether it is possible to prevent that collapse in corporate debt values and related securitization and related derivatives markets, to prevent that from happening, but rather it is possible to protect the credit systems of the United States and the European countries in collaboration with the credit systems of other major economic powers. And to do that, it is necessary to act immediately in order to separate those credit systems, the commercial banking systems, from all of the rest of this speculation. Had that been done, again, had the decisions of the 1990s to do away with Glass-Steagall bank separation, had they been reversed in the years immediately before the 2008 crash, we would have come through that with growth. Not that the crash would not have happened. We would have come through that with economic growth, as, for example, China did. And China, it's worth pointing out, is the only one of the major industrial countries in the world, the only major economy in the world, whose banking system is under Glass-Steagall bank regulation. It has been since the act which created the major public commercial banks in China in 1994, by which the PBOC acted with foreign exchange reserves to create those commercial banks. They have been barred from securities and broker-dealer activities from the beginning. So China has a Glass-Steagall banking system, not without problems, but nonetheless, it maintains that bank separation. It grew dramatically through and really grew the world economy to the extent that it did through the crash of 2008. The United States and European economies instead switched over to a regime of central bank creation of liquidity and ultimately of capital for the major banks themselves and they alone. And that policy inevitably started and immediately started to blow up the next great financial bubble, which has become, because of the overextendedness of consumers, of households, and their inability to take on any more debt. In fact, they had to get rid of some of it. It has become a bubble primarily in corporate debt and in securitized corporate debt in the worst areas, the worst quality areas. For example, the subprime and subprime auto loan markets in the United States, the commercial real estate markets, the oil industry debt, which has truly exploded since 2005, 2006, beyond any other sector, has become unpayable for a large part of that sector and has been securitized. So this is the situation that we immediately face. At the same time, for longer than that period, since 1986, there has been a lack of investment in a basic economic infrastructure, and therefore there has been deindustrialization occurring in the United States and in the major European countries. And that has created real economic forms of depression in those countries, even when the financial media have proclaimed growth and so on and so forth. One need only look at the United States economy and see that despite supposedly having record low unemployment at this point, there is a huge hole in the labor force of the United States, such that at the same time there is record low official unemployment and record low employment to population ratio for men in the American economy between the ages of 25 and 55. This is merely a symptom of the fact that the life expectancy of the American population as a whole has actually fallen slightly for the last 2 consecutive years, the entire population's life expectancy. This is absolutely unheard of in an advanced industrial country like the United States, but it indicates the tremendous hollowing out which has occurred in the labor force during the period of deindustrialization and lack of investment in basic economic infrastructure, not simply replacing what is there, but rather a lack of any creation of new generations of machine tools, of new generations of power sources, new generations of space exploration means. This has simply been set aside in all of these countries and has created a situation where a financial blowout of this kind will be even more devastating than it would be otherwise. We have to look at what really at this point the only means by which this hollowed out economic situation, lack of investment in infrastructure, lack of growth of productivity in these economies. The United States, for example, labor productivity basically has not grown significantly since the turn of the century. Total factor productivity, fundamentally much more important, has been absolutely flat and has not grown since 2004. The situation is similar in major European countries. This can only be confronted by doing again what was done at the end of the Second World War in the creation at that time of a new, what was called a new monetary system, and came to be called the Bretton Woods monetary system, but had the purpose fundamentally of two purposes. One, creating an international credit bank, an international investment bank to foster capital goods exports from the industrial countries into new projects, infrastructure and other projects for development of the developing countries. And the second aspect, controlling the fluctuation of currencies by currency and exchange controls and by simply limiting setting rules on the investment of capital in one currency outside the country from which that currency came. This system worked very successfully for a certain period of time. It was broken up by progressive deregulation and offshoring institutions which were set up in the City of London and which began to issue dollars from there rather than from the US Treasury and create the then famous petrodollar and eurodollar markets, which began to, by which the international circulation of dollars began to break up that monetary arrangement, that Bretton Woods system. This is exactly the model for what needs to be done now. There are clearly 4 countries, and Lyndon LaRouche has identified them since prior to the year 2000, just before the year 2000. That is the United States, Russia, China, and India as being the key countries in stepping forward and beginning the initiation of a new international development bank, and thereby of a new international credit and monetary system, acting at the same time to bring currency fluctuation and the floating rate situation under control, as it was during the period from 1945 to the late 1960s. This action, if they take it, there are summits immediately on the agenda involving the heads of state of those countries, where they are discussing very urgently matters of trade, matters of economic investment. They have to. This kind of action, if it is taken, can not prevent the sections of unpayable debt bubbles in these countries from collapsing, but rather can bring the banking systems, the credit systems of those countries through that collapse and enable the credit systems to function so as to contribute directly to such an international development bank. The purpose of this obviously is capital goods exports, development of major projects, as China has been setting the example with the Belt and Road Initiative investments that its major public banks have been making. This objective, to a certain extent, has already begun to change the situation positively, in a positive direction, in the economies of Africa, for example, and definitely in the economies of Asia. And this is pointing in the direction of what could be done by these four powers and others that obviously could be in an immediate second rank of this, could be done to create both currency stability and also a new international development bank, which would be capable of creating credit on the order of many trillions for such major projects. You'll hear more about what those are, what those must be, or at least what the most important of them must be. There are, for example, here in the United States, very, very urgent needs, not to call it a developing country, but very, very urgent needs, including those which bridge over into Mexico and Central America and have to do with alleviating the migration crisis in the same way that they have to do in Europe with regard to migration from the Middle East and Africa. These major development projects are of a size and scope which require an international development bank in order to create the credit for them. This kind of initiation is uniquely able to create new value, even in the process of a bank or financial crisis, such as we expect immediately, and therefore to bring us through it. Above all, what we need is to see these actions taken before the crash itself occurs, because then it will become much more difficult. We saw the fait accompli essentially after the 2008 bank panic, since those banks had not been separated from their many hundreds and even thousands of speculative arms, which had blown up, since they were still integrally connected to them in the form of universal banks. It was necessary to save all of the speculative, or attempt to save all of the speculative bubbles in order to try to save the commercial banks, all of which needed saving at that time. Therefore, the immense bailout which proceeded over the next decade, which has reached on the order of $15 trillion in currency issuance to these banks by the major central banks of the United States and Europe and Japan. So to avoid that, it's necessary to act in advance of the crash, above all on the first of the actions which is necessary, and that is the reestablishment of Glass-Steagall separation between the commercial banking and credit channel on the one hand, and all of the investment banking and smaller and more various speculative broker-dealer activities, derivative markets, to separate them from the credit channel, which has to be protected. That must be done now, because it must be done before another crash of this type actually takes place. So that's really what I wanted to present to you in order to set the table this morning for the presentations which you will hear.
I just have a question. Here in Denmark, there has been a series of banking scandals, starting out with the ability of the banks to help people avoid taxes through setting up things through tax havens. Then there was the gigantic money laundering case through the Estonian branch of Danske Bank, the Danish bank. And then there's also the looting of the tax coffers from not only Denmark, which has been hard hit, but Germany and other countries through the dividend arbitrage scandal, scam. So what would your advice be to the Danish authorities about how to deal with these banking scandals and the relation to our proposals?
Well, rather than go through a discussion myself, I would point people to a film. Tax evasion essentially originates in modern tax evasion originates in what was done in and around the city of London, beginning in the 1960s, exactly at the time when they were concerned to break the rules, break the barriers of the Bretton Woods monetary system from after the war, and to get control of dollar issuance themselves. They also, the City of London was also in the process of creating this vast array of offshore locations where not only tax could be avoided, but even the beneficial ownership of assets on a mass scale could be completely hidden. There is a film called The Spider's Web, Britain's Second Empire, which is really quite an excellent description of this process and what its effects were over an extended period of time until now. So it can easily be found on Amazon and in other places, and I would recommend that people watch it. The Spider's Web, Britain's Second Empire. This specific cases in Denmark. I know a good deal about the dividend arbitrage scandal, which is, of course, broader than Denmark. It is now being prosecuted finally in Germany, but suffice to say that entire theft of what I think is estimated at now 65 billion euro, $75 billion from the tax revenues of major European countries. That entire theft would have been impossible if Glass-Steagall bank separation regime had been in place. What these schemes involved were buying stock essentially across a dividend date, the date of issuance of a dividend, buying it with the use of a short seller, so that both the selling party on the side of the pre-dividend side and also the final buyer on the post-dividend side were in a position to either claim to have paid capital gains taxes on the dividends on those stocks, or to claim direct refund of taxes which had not been paid by anyone at all. So they both evaded taxes and also directly stole existing tax revenue from that had been paid by other taxpayers from the major countries of Europe. They did it on a mass scale by not buying one share and then across the dividend, but rather buying millions of shares across the dividend. And so they could never have done this without networks of asset managing firms, investment banks, investment funds that were brought in some cases from Ireland, from the United States, from various places. All of the personnel of these asset managers and so forth were experienced traders from the major commercial banks. And most importantly, for most of the nearly 20 years that this scam has been going on, the short sellers were the commercial banks, that were the universal banks themselves. And when they finally backed out of doing it themselves, they loaned the money to those who did the short selling. And therefore, they were directly violating a Glass-Steagall regime, which says that a commercial bank cannot make loans for the purposes of carrying security broker-dealer activity at another firm. This is tremendously costly, and having read somewhat into the adventures of the schemers in these schemes, it's very clear that even up to the very top of some of the big banks involved, for example, Macquarie Bank, HSBC, even up to the very top of them, their executives and officials and all of the traders involved, but particularly the top executives, were aware that they were committing crimes before the tax authorities in Germany and in other European countries were willing to admit publicly that these were crimes. The bankers who were carrying them out knew very well that they were crimes. This was a complete failure over nearly 2 decades of bank regulation, and would have been immediately stopped and prevented from happening in the first place if the banks had not been universal banks, but rather Glass-Steagall regulated, separated banks. That's what those of you who have such responsibility in Denmark or elsewhere in Europe, that's what you should do about those scandals, in my opinion.
Okay, thank you very, very much, Paul, for this important contribution to our seminar.
Okay, I hope you have fun there.
Thanks a lot.
And get that Fehmarn Bridge built.
Right.